Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, July 1st, 2025. It's 12:44 p.m. Eastern Time as we're kicking off the first trading day of the month. So what I'm going to do in this one, a little different. Things have been slow, updates have been slow, and I'm going to start here. I want to just go back a couple days and go over. There's been some good questions and comments put up on the in the comment section under some of the posts. So we'll do that. And then I will, and I'll tell you now if you have any you want updates on any charts, whether it's something I've covered, something I haven't covered, throw it out there. I'm in quasi vacation mode, and so I'm going to start out here with this comment. Trader68 asks, Randy, this is a Friday. This Friday is a holiday and Thursday is a half day. How does that affect the charts? Great question. As you know, I've been doing this for a long time, and this is what I've always called kind of, how there's peak earnings week, and that's usually when the bulk of the Mag 8 report within a 1 week window or so. That's peak earnings. And this is kind of what I call peak summer doldrums day. For those of you not aware, summer volumes taper off. Traders, investors, whether they're professional traders, part-time traders, people on vacation, kids are out of school, so that's that. And so you see the volumes drop off, and then this, of all things, is what I kind of call peak summer doldrums week. You've got the, as Trader 68 mentioned, you've got Independence Day, July 4th, and then a half day in there. Plus, we're right at, so just about everybody. I'll give you an example. My wife, her company shuts down each year this week, and also the week between Christmas and New Year. So I didn't even realize that was coming up. She's home. My other son was doing an internship. He's a college student up in Jersey, and we flew him home because they're off for the week too. And so I've got 2/3 of my family here, and I'm in quasi vacation mode. I'm here. You've been getting updates every day, but spending time with them. And the other takeaway is, and this is why I'm doing this. It's been my experience that on this week, because of the low volume, it's best to take breakouts with a grain of salt. Any big moves, I always say this: a big move in the market or in an individual stock, to me, means absolutely nothing unless it triggered some type of technical event. So, in other words, a 3-4% up move on a stock, or a 1% move, maybe even 2 on the index, may have technical significance. It does if it broke down below a key support level or a trend line or a breakout, or there was some bullish type or bearish candlestick pattern form that day. Then you have some technical significance. Otherwise, it's just noise within the machine. So so what I went on to say is best to take breakouts with a grain of salt, or keep your trading activity and position sizes light until most of the players step back on the field next week. In other words, people start coming back off vacation. And again, it's not to say a breakout can't stick. It's just from my experience, you get these kind of low volume is fuel for the machines, the algos, trading desk. Back in the old days, it used to be the market makers. A lot easier to move a stock in the direction you want to move it on low volume. And again, whether it's intentional, nefarious forces trying to run stops, big trading desks or algo programs, or just the fact that it is low volume and it takes less buying pressure, a couple big orders on one side or big sell orders, especially from institutional traders, can move a stock more than it can in a higher volume market. So, all right, hard stop. You got that. Just keep that in mind. And again, I'll be checking in and out. Might take a day off this week. Go out, take the boat out. I don't know. We'll see. Let's see. The market did a V recovery. Yeah, I'll just continue on this thread, and then I'll go back. This is today's post, today comment section under the last post that I made. I've been a member of the COVID crash. Market did a complete V recovery in 3 months. Didn't rally. What's the difference between now and then? So I did reply to that, I believe. Yeah. Okay. So here's my reply. Not to sound facetious, and I mean this, but anything's possible. I often say that anything's possible. Therefore, I only deal in factor into my trading in probabilities. So, of course, a blow off top, and I mean it, it's certainly possible. like 1999-ish style, if you guys were around then, or you can look at the charts. We already had a dot-com bubble. Everyone knew the market was running hot. Valuations were insane, but it got a lot more overbought and a lot more overvalued until the top was finally in. So yeah, anybody, not me, anybody that says that we can't have that type of big move, 10-20% more upside in the market, even a very sharp ramp, is an idiot. Maybe Trump's big bloated bill gets all the way through the House, gets passed, signed into effect. Anything is possible, right? But I don't speak in possibility, I speak in probability. So there's a lot different now than back then. Both technically, and again, for me to sit here, it would be an hour-long video, and this is what I do day in, day out. I've done a lot of these videos. The technical and fundamental backdrop are a lot different now in the market. Fundamentals, I certainly factor in. I have a background there as well in fundamental analysis, as well as technical analysis. Fundamentals are your, things such as evaluations, and when Warren Buffett's a fundamental, stock picker. He reads balance sheets and buys a company and is going to hold it for long term. Traders use the charts, technical, especially active traders. It's impossible to trade on fundamentals in short term. They do play out over the long term. There's no arguing that. However, it can take years. And Buffett was famous for, taking a position and being patient, even if it took, many cases it did take years to pan out. And ultimately his call was right. But as an active trader, you'd be wiped out if you put too much in a position that takes 2-3 years, it goes underwater. Traders are going to use those technical levels, smaller stops, smaller, especially swing trading, smaller price targets typically. All right, so again, that's possible, but in my analysis, including but not limited to the difference in both the technicals, the charts now, and fundamentals, I put the odds at very low of a blow-off top. I've been stating for months now about coin toss odds, whether this market, once it got through the 200s, I clearly stated, once it was above the 200s and even before we got to the top of my scale back in shorting zone, I said no more adding shorts for a long-term swing trade or long-term trades for those longer-term targets that I still maintain as long, if and as the markets were above the 200-day moving averages. And that's been months now. And so there hasn't been any signs or evidence or reason, any strong enough sell signals. Like I said, I want to see the markets drop back below the 200s to either add or initiate. I think that's my opinion before initiating long-term swing positions. Again, please don't mistake a short-term swing trade setup. Even on the same security, I do that quite often, whether it's something like the gold mining stocks, gold, or the stock market, or just about anything out there I trade. Typically indexes and commodities, where at any given point in time I may be long as a long-term investment position in longer-term accounts, but then short-term trading, long short, the rips and dips off the 60-minute charts, the intraday charts, going for pullback trades and things like that. So anywho, that's it. So nothing has changed. And again, for months since we took out the 200s, I've been very open to calling about coin toss odds, whether this market was going to punch out, make a marginal new high, meaning relatively, small high above, whether it's 5, 8, 10%, probably less than 10, above the previous highs. It has a pattern of doing so as long as we still had, which I said we would certainly, and that's held true, still have negative divergence on the daily and weekly time frames. So we still very much have that. So in other words, nothing has changed from a technical posture of the market. They are overbought with negative divergences, and so expected it if we did pop. And again, it was about 50-50 odds. We did pop the new highs, and that's it. So now looking for number one, a reversal failure back down below. I'll get to that in a second on the charts. And I've often said this, and I've said it recently, and I'll say it again. From my experience, when things break out the new highs, especially the indexes, it's more than common that you see them come to back test, meaning pull back down, test that previous high, and usually go down a little bit through it. It's just more often than not, instead of making a perfect back test, they'll go down. So a little bit of a breakdown below the previous highs is not in my opinion, an all-in aggressive short moment. At that very moment, yes, the breakouts failed. However, you want to continue to see it get away from that level because it's pretty common to come down through there. The powers that be, whatever it is, want to clear out the stops, and see some aggressive short sellers short that failure right away and then gun it up. So just keep that in mind. So it's more of an incremental thing. The farther you get, if this breakout fails in the S&P 500, Nasdaq 100, every tick lower down below those previous highs increases the odds that will prove to be what we call a bull trap. That's a breakout to new highs that fails, or any type of breakout of a bullish chart pattern that fails because longs go into there, and then when they realize the breakouts failed, they start stopping out, and it's more of again, kind of like a vicious cycle. The lower you go, the more those traders are underwater. It's like a short squeeze in reverse almost. All right, so that's that. And this is very, very important. So my expectation of a marginal and still divergent high, which is followed by a failed breakout and next leg down to my longer term targets on the weekly charts, is still very much my preferred scenario. This is important here because I get more, by far, 90% of the chatter on the sites about the equity markets. As always, I'll have my bet spread via position diversification. That means, for example, in the stock portion, longs and shorts. I don't think there's any point in time, at least can't go on for a week or two on this site, in the history of the site, where you haven't had, or at least over month to month, both long and short trade ideas. I tend to go short the most bearish looking stocks and or sectors, and long the most bullish. And if you look at the handful of longs that we've had in the last few weeks, they're by far blowing away the market in performance. And so I don't get a lot of that. And what I can see here is that some people want to put everything in SPY or QQQ, long or short. It's a single position. The SPY, or S&P 500 index fund, or QQQ, they're great if you are an investor and you have a long enough time horizon. Yes, you can put all your money in SPY and you're diversified because you own 500 companies, large cap companies, so stable companies, among 11 different sectors. So you have very broad coverage. You want to give even more diversified, go to VTI. It holds small, mid, large caps. It tracks the entire stock market. So yes, as an investor with a long enough time horizon, even though I think you should round it out with proper asset allocation as well, stocks, bonds, commodities, things like that, maybe a little crypto, that is an investment. As a trader, it's a position when you're in SPY or QQQ. So I'll do me. You should never have all your money there. So if you're feeling pain on an index short right now, it's because you're not taking Pepsi, Verve recently for 100-something% gain, OSCR, Lululemon. These are just some of the most recent long trade ideas that, again, are blowing away a magnitude of performance. I haven't put a lot of longs out there. So if QQQ was a single short position and then you took those other longs, well, and again, QQQ, the last time we haven't had a sell signal or a short entry on that in a while, then you are, again, vastly outperforming the market. So I have to say that because I get these comments that people just, seem like that's the only game in town here is to, go long or short the market. So here's one. Yes, hedging and diversification is always a good idea. It's not a good idea. It's paramount. It's paramount in investing. Again, I used to be a financial advisor. Studies show asset allocation is more important, your mix, than security selection. They've done these studies over time and time again. Security selection is individual stock picking. And again, this was done from professional money managers and individuals, but that's a more important determinant of your long-term portfolio success, again, from an investment perspective. But I always say the same premises hold true for active trading. So that's it. And especially right now in a counter trend trade, whether you're short or long the S&P 500 or QQQ, but when you are taking those positions as a counter trend trade, which any shorts on the index right now are clearly a counter trend trade, it's all that much more important to take some diversifying your bets. They're not even hedges. You can call them hedges if you want, but the stocks that I'm targeting right now, you can see have very little correlation to the stock market. The stock market's mostly the big run up is tech stocks. Pepsi, although it is a component, I believe, of the S&P 500, it's one of the more beat down ones. So there was value there as well. You're buying a blue chip stock, and those are the ones that are more comfortable, or the obscure ones that aren't in the indexes or aren't tech related, like the Verve trade and the OSCR and Lululemon and those others. All right, so okay, I don't want to beat a dead horse, but that is again just as, if not more important in swing trading as it is in investing, is to spread your bets, guys. And then as I always say, if you don't agree with outlook on a trade, don't take it. I throw a lot of trade ideas out here. I don't take every trade idea that I post for various reasons. So, and I'll tell you when I post something, how my convictions are, if I really like it, have a lot, or hey, it's just an objective entry. If you like it, take it. And if you don't, pass on it. So yeah, there's that Herman Munster. I appreciate these feedbacks in real time. I really like to get this kind of feedback from people that are in industry and and have the visibility to see what these tariffs are doing. We all know this. Again, there's been, as any bull market, you talked again, the 2000 bubble was probably the best example in recent years where people begin to think this time it's different, and fundamentals that have always mattered don't matter. What we do know, and again, I think it was Warren Buffett, we'll keep talking about him, because he's been in the news headlines recently, stepping down finally, but still considered the GOAT without a close second, the GOAT of investing. And, he said that tariffs are paramount to, nuclear war or something. I forget his exact quote, but there's no positive spin on a trade war. No positive spin at all. And what we do know is there's a lag time, just like with interest rate cuts or rising interest rates like we've seen, just like a lot of these indicators that we have, like the yield curve recently, uninverting, things like that. In tariffs, absolutely, there is a lag time where the retailers will start to pass it on. Heck, I'll give you one example. My wife and I went to a nursery this weekend. We bought this big fancy plant, and we need some planters out back. We just did a project out there, and we're looking at some of those big, healthy bowls. These are 2 planters, heavy. They got to be drop shipped, come by truck. I think the cost was $1,000 on the pair, and the first site I found them on, when I went to go add them to the cart, I'm like, okay, they're priced. They're made by a major company that Campania or something that sells these kind of potted goods that are made in Vietnam or China and come over. And so the first company, we're out of Denver, I went to go buy them. As I get into the cart, you have to click accept. Due to the Trump tariffs, we're adding a 18% surcharge. I'm like, fuck that, because I found them, elsewhere. And, but again, my point is, they're the first. There'll probably be more that will follow, and a lot of retailers, you read about it, will initially eat those costs, but ultimately, when it seems those tariffs are here to stay, they will, and you're going to see, you have been seeing it more and more. I've been seeing it. I do most of my purchasing online because I work from home, and what I've always done, and I've especially since the whole COVID thing and inflation started. Again, because I work from home, I get a package almost every day from Amazon or Walmart.com or any of these retailers. I'm clicking everything I need, and you get when you work from the house. Why, if you can, it's at your doorstep tomorrow. But what I love to do, and I encourage you to do this, go to your order history for the things that either you bought or may buy again, or just something you bought, remember, a year or two ago. Look at it from everything, and you click an order history. Look at the invoice and look at what you paid for that item. Look what it is today, and you will see that I think inflation is still being understated. And again, the impact where I'm going, I know I'm talking long-winded here, but the impact on the tariffs is real and is not going to go away, and is only just starting to percolate in again. Because everything's been kind of fluid, and Trump, that whole taco trade, Trump always chickens out. However, well, we know we are in the trade wars are here, and again, it's only going to be a net catalyst, for higher prices going forward. So again, let's just move on from there. July 9th is tariff day, another taco rally. Um, but yeah, I shared my thoughts on that before, right about the time that term started coming out, and then Trump commented on it. Like Trump or not, even if you like him, you have to admit he's probably the world's biggest egomaniac. There's the guy's ego's the size of Texas, and I remember he was ticked off when he got that moniker, that the taco Trump always chickens out. Someone with a big ego is probably less likely now to do it again. We'll see. He didn't, Canada. He didn't back down. Canada backed down recently with the internet the tariffs that they were going to do. So Trump, up the tariffs on Canada as they were going to charge that service tax to the internet companies, and then they cowed down. So that wasn't a Trump chicken out. That was more of a Canada thing. So anyway, that's just my 2 cents. I can't get in the guy's head, but I can tell you, I think he's less likely. All right. So can you update gold and silver? I'll do it in this video. We'll do it right now. I just covered that, I think, on Friday. There's no change. Okay, let's jump into that. Sorry, I had to pause it there. I had a notification just come through. Let's see here. Where are we at? And this will kind of segue into the next question too that I had. All right, so no change in the technical posture. This is GDX on the daily chart. You can see and I have these lines. If GDX, like the market, wants to go and make a marginal new high anytime soon, it'll be a divergent high, meaning if you take this line like this, and this is not a prediction of forecast. It's just if it happens kind of thing. It's that, divergence, as I always say, is not a sell signal. It's a condition. It's a condition that more often than not, as it was there and there, is followed by a trend reversal. That one was bigger. And what happens is usually you get these series of divergent highs that culminate. If you keep that divergence building like you did there, finally it manifests typically in a bigger correction. And that was, as I mentioned back at the time, a divergent low. You can see my annotations, the trend lines on the price and the momentum indicators below. Positive divergence is bullish. And in a bull market, you tend to go up more after divergent low than you drop. In bear markets, you get corrections. I'm sorry, primary bull trends, you get corrections. And so at minimum, looking at probably another correction. This was a divergent high. That was a divergent high. That may be the one to do the trick. Sometimes you only get one and then that's it. In fact, you only had the divergence here on the RSI. You did not have it. This was a higher peak right here. So that was only a RSI divergence. I should probably clarify that. Sometimes I'll do that like this and just says only divergence on the RSI. It was enough to give you that little correction. Now we have them on both at this point in time, both the PPO and RSI. And now what do we do? You never, if you're going to go from, if this says you're going from point A to point B and point B is down here, let's say, you don't go straight down. You hit the first support level. This is a level I've had here for a long time. This level is created back in April. It's nice support. You see it was resistance, and then boom, big green breakout candle, right? That shows you how significant that resistance level was. They came in and they back tested it. And they came in and they back tested it. They came in and they back tested again, bounced so far. If I thought that was a resistance then and then support there, my confidence now that it's a valid level is that much higher due to these recent reactions. Therefore, it's very simple. If that 58, 70-ish level, 50, 70-ish level goes, especially now you have a recent low, you spiked intraday down below there and closed right on it, that will be a more powerful sell signal and most likely take us at minimum to this trend line and then this level and possibly quite a bit more. It's a pretty big divergent high. Last time we had a divergent high and it played out for a decent correction. It was a 25% drop. So far off the divergent high, we've only dropped 7%, and that's it. So again, this may sound, I don't want to make it sound overly simplistic, but as I often say, it's one of my yogiisms, support is support until and unless broken. So we broke the trend line, we went down, we hit the first support lever, we bounced exactly where I'd expect us to bounce. You can see it on my 60-minute chart right there. So again, there's really no update other than the fact we hit that support level. Where did I do the last video? I think it was Friday last week, right here. So that's it. So we hit that 50.82 support. We bounced as expected, and we could bounce again. But each time you hit it, increases the odds to probably be taken out ultimately. Now, if they don't, we go up. We're going to make a new high. And if we make a new high, again, anytime soon, that's the condition. It has to be relatively soon. It will still be a divergent high and set the stage for a potential bigger drop. So that's it. But again, right now, we're kind of in no man's land, smack between support and resistance. We need to break 50.82 or really that recent low now that we've established it just below it, about 50.34. And then it should take us to this trend line. Yeah, price, but this was the previous trade here. We hit the T2 level in pre-market. We bounced. And that's still, since we had a reaction there, remember that was laid out before we even got there when we shorted it here. And we hit it and bounced, that further validates that. So that's a potential target there. And then T3 was never hit, and that's still support and still a potential target there. So that's it. But as I said, and I did an extensive, I've done pretty in-depth coverages on gold and the miners. I've been telling you, gold's not going to go down very far unless the dollar reverses. The dollar is exactly where it was a couple months ago when I told you this is a long-term support zone right here. This big purple box is a trading range. We hit it there. We bounced. That was that previous correction when we shorted GDX and hit T2. We got the bounce in the dollars expected, but we also went up to my first bounce target, which is resistance as expected. Reverse there. We reversed all the way back down. I didn't know or have any idea if we'd come back down again, but we did, and it's the same support level. It's this previous reaction low, and like I said, it's a positive divergence. And so any dip below there will most likely be a failed breakdown, and the buy signal is going to come, two buy signals on a solid recovery back above that 2690 level, and then especially on a break of this trend line. That's that primary downtrend line. Remember, we only had an intraday breakout recently, but failed to close above it. So that's not even a failed breakout. If you're using the daily chart, you have to would have had to close below there and then fall back below. So that's it. So if we pop this, and I still think it happens, then you get going here. Now then we'll have to take that level out. And so to get a deeper correction in gold, more than just a quick 10% or so pullback in GDX and all that, you're probably going to need to see the dollar make a more sizable reversal here. If it just breaks down, starts going down, especially if this divergence gets taken out, then that's pretty bearish because that's a big trading range in UUP, the dollar index there. So there's my update on gold, guys. And again, GDX is going to follow gold itself. Gold's been going nowhere. Gold bugs, gold doesn't pay a dividend. Gold bugs have been, gold's just been trading sideways. I like to typically trade GDX or silver. You get more bang for your buck. Silver put in that divergent high recently, and it's now confirmed. When I told you a couple weeks back, it wasn't. We got the bearish PPO crossover that effectively gave us a negative divergence, meaning made a bearish PPO crossover. So there's a lower peak in the RSI and RSI down here, a lower peak in the PPO right there. And again, divergence is not a sell signal, but silver is going to follow its big brother gold ultimately. The best trades in silver when it's been lagging or getting too far ahead of gold, and then gold makes a trend reversal, and then ultimately silver plays a pretty powerful game of catch up. You can see that here, just back right here a few weeks ago, April 7th, a couple months ago. Silver was way off, its highs, and gold was rocking and rolling back then, to new highs. And so you can see the powerful game of catch up. Gold didn't go anywhere, but silver played that game of catch up. So gold starts moving down, and look at that technical posture. It's just, guys, I do what I do, and these are what I see in the charts. And now, you can sit here, and I can do this all day long. You give me any security, I'll make a bullish case, a bearish case. So what is bullish? The PPO is a trend indicator when it's above the zero line, and I look at the 9 EMA, always the last of the two to cross. It's bullish, bullish, bullish. It has been. This is in a bull trend. So we have the negative divergence, but if the PPO bounces, we could get another leg up, another high. Any new high soon will be a marginal new high. Let me translate this for you. I think the upside in gold appears limited. Is it possible this trading range you could break out and have a rip? Yeah, sometimes that happens when you have trading ranges. It's like energy building like a coiled spring. However, any new high will be a divergent high anytime soon and will probably fail. So, in my opinion, just like the stock market, exactly like the stock market, the RR, the risk reward ratio, is not favorable to chasing a breakout or going long. Now, you can take it, guys, because the one thing I give you a few guarantees in trading. One of the guarantees I give you, and I give it to you a lot, is that I will be wrong and I'm going to be wrong a lot. So, therefore, take any trade that you like, but you have to use stops. And if you want to take gold, there's nothing wrong. Just because I think the breakout will fail and that I won't take a breakout alongside doesn't mean that it can't do that. So if you take it, just set your stop. If you see the breakout clearly fail, recognize that, because that would mean that the whole thing's a bull trap, false breakout. You can take the divergence, and you're probably going to go down to and then ultimately below the trading range. So there's your update on gold. Right now, nothing's changed. My outlook bearish, my positioning's bearish, but I need to see for GDX, I want to see those recent lows break to add to that position. I have a little core short position that I'll trade around in the less active trading accounts, and then I'll add to it, and silver as well. Silver is my preferred proxy at this point in time. Okay. Let's do this. I wanted to just take it back a few days. This is where, recently a lot of the comments came through. So I'm going to go now, work our way back. Again, just show you my replies to questions or answer any questions that I might come across now. All right. Oh, yeah, this is the one I already talked about. The holidays coming up, how it affects the chart. Oh, okay. So we were already here. I guess this is where I started. My bad. I thought I'd start on a different thread. Yeah, somebody brought a good point here about the where is it? Yeah, Trader 68. And you guys really need to understand the gravity. I did not understand the gravity of just how much money when COVID hit. Again, there's no close second in history, not even a close second. What they did, and I've used the expression many times since, the federal government and the Federal Reserve, no, not just the federal government and not just the Federal Reserve. Let me correct myself. I've said this multiple times before. All central banks around the world. That's not just the Federal Reserve. That's the ECB, all the big banks, the Bank of Japan, and all governments hit the nuclear button. They all freaked out, thought the world was going to come to an end. This is biblical shit. The plague is here, the pandemic, and they freaked out. And we all know that. And they threw money and crammed money down people's throats. Whether you had a business, whether you're having your best year or not, you got a lot of money. You got checks in the mail, free interest, free money, zero interest rate policy, quantitative. So they did all that. And so, yeah. $6 trillion in government. I don't know, whatever the numbers were. That sounds about right to me, I guess. That will move the markets. And the thing is, so if you're one, and this is now we have the Fed put. They did that then because they could do it. There was zero inflation. Government borrowing costs were very manageable, very low. And we know now they can't do that. Now there's this, we already saw, and the last time the market wobbled, when we were short earlier this year, the market started to freak out because towards the end there, instead of interest rates coming down, a lot of institutions running to bonds for a flight to safety, they did the opposite for the first time in modern history, especially during a very hard sell-off in the market. Interest rates started going the other way because they were concerned. They said the bond vigilantes were finally showing up and selling treasuries, causing long-term rates to go up. And so because of that, and the fact that we are still, again, guys, within spitting distance of not only multi-year, but multi-decade highs in interest rates. This is TYX. This is what it looks like. This is what I've covered many, many times. This was our secular bear market in interest rates, this price general falling rates. There was the nuclear button hit when COVID hit. These previous drops were the bouts of quantitative easing, starting with the financial crisis in '08. So you had that, that market hitting, the Fed and the Treasury hitting with quantitative easing, and then boom, this is again, they just hit the nuclear button, brought rates down to the floor, and we ended that secular downtrend is over. And again, I maintained repeatedly since that time and that we would most likely enter and have clearly entered a new secular bull market and rising rates. It's going to, how it's exactly it's going to play out, I don't know. At best, I see, or at worst case, we could get an abatement of yields to come all the way back down and back test the trend line and then go up. And depending on how that happens, and if it happens, it could be bullish for equities if it happens organically, meaning rates pull back on organic forces, market forces. But if it is because the market's heading down hard and it's a flight to safety bid, that's not a net positive for the market, or at least not at that time. So now, however, that's one scenario. And what I'm going to do and what I continue to say, this is something worth monitoring. As I've told you recently, I've been trading the snot out of treasuries for years now. We've had a lot of good, and I've shared on the site, a lot of good swing trades, probably batting over 800 easily on treasuries in the last couple of years. But right now, it's more of a watch and see to see if we can break out. And again, this is where we're at. This is a monthly chart right here. Let me park the just leave the histogram up for now. But so if we take out that previous high on the 30-year, we're going all the way back to where rates were. Let's do it here. I've done this for you, but it's worth repeating because we're so close. We're a higher risk now, or closer in price. That's right there is the financial crisis, 08, 07, 2004, 2000. This goes back into the 90s right here. So again, if we break out, we're going to break out to multi-decade highs in yields. It's going to be a big technical event for the market. It'll be a huge fundamental event for the federal government because our borrowing costs are just to service the interest on our existing massive load of debt. And so that's it, guys. So, and right now, again, I'm talking about this breakout, whether it happens or not, because right now we're a lot closer to that than breaking down below this trading range. So if yields start moving down here, I'm going to say, okay, well, the market can breathe right now because we're farther away from there. We're not just what I call a quote unquote bad day or two away. Bad day or two means, boom, we do this. And you can see as I jump back down to the daily chart, within now maybe a couple weeks, we could technically be there. So, all right, so that's it. So those are things to watch. All right, let me go on through here. So yeah, I already addressed this. The possibility of blow off top, certainly possible. I don't think it's the most likely scenario or even a likely scenario, but not very likely. Yeah, but everyone thinks the market's invincible, and that's one reason to be careful now. Yep, we already covered that. Taco rally coming up. We'll see. Can you update gold, silver, which I just did. Okay, so that's all right. Let's cover a few more things, and we'll try to wrap this video up. So that was all. Where did we go back to? We went back to right here, QQQ long-term charts. Yep. All right, let me just check, see if I missed anything here. That was yesterday. I threw out Pepsi as a trade idea about a week or so ago on one of the videos. That's where most of the trade ideas will come from. And, here's one. Somebody asked me opinion on NRG as a potential short based on negative divergences and big gap below. Yep, traders love these gaps. There's an unfulfilled gap. Gaps are often, not always, but often backfilled at some point. And, yep, that is exactly how I see the chart. You have negative divergence, big divergence. And so I said it would be a short on either or a break of these two support levels, 152.90 and or that 147.75. Two targets denoted by the arrow breaks, which would be that second target. First target, they're going to come in. That's the top of the gap. Probably bounce it there, buy it, and then go on. Once the gap's entered, it'll probably be backfilled. So that would give you a pretty nice trade. So there's NRG, set price alerts, or however you want to trade it. But yeah, I do agree with that one. All right, QQQ long-term charts. I think that's the one we started out on. Lululemon we had Pepsi and Lulu hit those first price targets. When I threw them out, told you I had to sharpen my pencil, which I did. Yeah, it was, here I gave props to Rugi, Rugi, however you say that, Rugii, for pointing that out to me. And then I, posted the chart. Yep, there it is. So good job. Somebody made some money off that one. And again, these I have a lot more comfort with right now. These bottoming plays. I've traded a lot of markets. When you get to the top, what happens is when the market gets or breaks out to new highs, and it takes the Mag 7, the tech bubble, to do that and lift them up. Then you get bottom feeder bargain hunters coming in, and so then you look for brand names. Lululemon, yeah, they had their problems. Admittedly, we all know that if you know what's going on in the company, but they've got some. That's still a very popular brand, huge brand name awareness and goodwill there. Pepsi, come on, I mean, it's Pepsi. So these are the ones that, as long as this game of musical chairs continues, meaning the market goes up, this is where you're going to get better, much better RR. And remember, both of them buying these stocks, at support. Pepsi was at long-term support. So worst case, Pepsi I thought might have been dead. No, worst case, I'm sorry, you get stopped out. All these trades have stops. And best case, you're going to outperform. So again, you can vastly outperform right now by stock picking than playing the indexes. The indexes have just grinded higher, but really haven't gone that far in weeks. We had a little breakout recently of the trading range. But either way, that's what Lulu looks like. And let me go to Carrie. I haven't seen these comments yet. Just threw this one out to you today. Like I said, take it, don't take it. It's up to you. I like the candles on some of the big guys. These are the big banks: J.P. Morgan, Citi, Bank of America, Wells Fargo, and that candle on the broker index might turn out to be perfect today. I've been focused on QQQ SPY, but I'm now adding equities to my trading. Good luck. Okay, wish you luck. On that, okay. Just remember, guys, you have an earnings calendar. You go to resources up here on the top menu of the site. I highly encourage you to know when you're trading individual stocks. It's one benefit of the ETFs, sector ETFs, and in the broad market ETFs. Nope, it's not there. I'm sorry. Earnings calendar. You need to be aware of when your positions report. So you just type it in up top here. Yeah, maybe you can't see it. Type in ticker, whatever your ticker is, whether it's Lululemon, and then just know when they're going to report. They're just September 4th. And then sometimes these dates can be off. If you want to be certain, you can check the company's website. Go to any company, publicly traded company. There's usually investor relations down on the bottom menu or whatever of the site, and you can. They'll usually announce closer to the time they're going to report when that date will be. And like any trade, it either works out or it doesn't work out. So the chart I gave you today, the first one, this is the new trade. I'm going to say my convictions aren't as high, only because the market is in that strong uptrend without any signs of reversal. They've been buying dips. So back here, I did have a higher degree of confidence in the trade, and gave you a couple updates there and told you if when T2 went, it's going to increase the odds that those additional targets will be hit. And that's what happened. T2 went right there, back tested, and we hit my final target right there. This is a 60-minute chart, so within a day or so, we went slightly lower. And so the new trade is in green. I just turned these old levels that were white into purple so you could see, because those lines aren't as relevant anymore. But just to show you, that at times, it's a counter-trend trade. We were within, like I said, spitting distance of new multi-year highs. Almost everybody wanted to buy the regionals then, just like today. Certainly buying them today because Trump's big bloated bill just passed, Senate, and it's going to, part of it is he wants to reduce regulations and everything else. So people are buying the regional banks, and the regionals, if you haven't noted, will really determine. They track with IWM almost perfectly. So IWM is up, along with the regionals, but it is at resistance, and so, like I said, that's my trading style. We've got. Like I said, for the first time where this is nice resistance. This is a line I've had here since created back in February 2025 and not modified. It was resistance here. We had a breakout there. Then it acted as support. We flagged around it and then broke it, and all that happened. That's when we shorted the banks right here. Perfect entry. That was on the 60-minute chart I just showed you. Down there, we covered right there. So we milked just about, here it was on the 60-minute chart, with impunity, just about nearly every cent left a little. But then again, we were still short overall and everything. And then that was when I started saying no more shorts, covering all shorts, going to a hard long position. And so my point was, we've come full circle. Up until now, not even there, we did not have, right here is where the divergence started. That was a lower high. So we've just now finally, for the first time since right here, the last time we shorted it, again, when everybody wanted to buy in, was bullish the market and regionals, and we got that, this is what it looks like. Again, we've come full circle. Like I say, divergences are not a sell. So that's what stops are for. Last time I gave you a stop over 68. Fortunately, we got in and it started paying off right away. This one can go up to 66. As I told you, that was calculated on an RR if you're targeting T3. But bigger picture is, let me go to the weekly chart. This is what it looks like on my weekly chart. And what happens if we get down to my third target, that means the regionals are going to have dropped. Hold on, let me just do this for you. If we get anywhere, T3, by the time we get there, is going to be another 24. Exactly what we did there, 24% drop. And so if we drop 24%, let me go back to my weekly chart. On the regional banks, they're going to be back down to that previous low. That is almost certainly going to coincide with a pretty good drop in the stock market. And if we drop in the stock market, we'll go back to SPY, the S&P 500, then that's probably going to have brought us back below the 200-day moving averages, which again, to me, is a big, big thing here. So there's the 200s right here on the weekly chart, the 40-week. And so there's that previous high, like I said, all the way along. Any new high anytime soon, which, especially once we took out the 200s right here, that gave it coin toss odds whether we'd go up and do exactly what we've done today. Make a marginal new, still divergent high. Just take that divergence line. That's what I'm doing here on SPY. I gave you just yesterday what I'll be watching for this week. This is a weekly chart. Right now, this PPO, the signal line right here, that white line is slightly above the zero line, but that's going to change by the end of the week. We're either going to be, unless we close the week right where we're at today, we're either going to be higher above it, and then that's another check mark for the bulls. There's no way to argue. It's not a be-all, end-all. It's one of many trend indicators that I use, but that would be bullish. Or if by Friday's close we're down, then it's going to be a rejection off that level. And quite often, once you're below it, you don't see it here on SPY, but a lot of times it delineates the bull and bear trends. Again, this is 21% drop off the highs. Again, off the highs, not they coincide with the drops. COVID, 36% drop. These are the only times in recent years, going back to the 2018 or beyond. You can go back as far as you want. Here it is, all the way to 2015. You're rarely below there. It works as a great trend indicator. It crossed below recently. It's crossing above now, but it's a weekly chart I analyze this on. So all that matters is Friday. So I'll be watching that. And again, it's not a be-all, end-all, hard all-in. And again, just because it crossed over, my thoughts. It's not going to be, for me, okay, let's put everything now and go to a full long position. We still have the divergences, everything else. You look at it from a price perspective, QQQ broke the primary trend line right here, back tested. So as I gave you that post earlier this week, these are the things I'm watching for this week. And I also shared with you that all the indexes still on the PPO monthly chart, my longest term. This has been an effective trend indicator. All the big corrections, all of them, every single one in recent decades have been characterized by the PPO trading down below the PPO histogram and negative. And so sometimes, look, we might cross. Looks like we're going to cross soon. We didn't cross last month. That's why I gave you that update yesterday. Yesterday was the last day of June. Now we've got a whole month. And this thing, so if this trend indicator, on July 31st, if we've got a big green candle, that's just one more thing that says, hey, we might have a nice big blow off top. We might continue on up. However, if you get rejected, and a lot of times it looks like you're going to cross, sometimes you start going up and you don't, you get rejected, and it keeps the trend intact. Um, don't have many examples on here, but that does happen. And so we'll see. We'll see where, again, I'll update it in July. It's July 31st. I'm sorry. No reason to do it now. Oh, the last one, I just had to go back a little bit further, make sure if anyone caught this. This is a good question. And I appreciate these kind of comments and questions. Piccolo3 said, you are bearish mining stocks, meaning gold mining, because I had just done in this one a video on the precious metals and miners. That was Thursday or Friday. But bullish on lithium, question mark. Isn't lithium considered a mining stock? Help me understand. Yeah, of course. But lithium and gold have nothing to do with each other. They're mining again. My reply: mining is simply extracting something from the earth. Lithium isn't the same as gold or silver. A completely different metal extracted from different places with different supply and demand dynamics. In fact, here's a chart of GDX and LIT showing that they don't always have an inverse relationship, but they have. Lithium has been going down, just like the Pepsi and Lululemon. I'm bottom picking, brand name, blue chip, established companies right now at support. As long as this little game of musical chairs goes, those are great. Those are the ones I feel comfortable with taking as long positions versus chasing, these high-flying tech and AI stocks here. So lithium, you can see since 2022 has been clearly in a bear market with GDX in a bull market. So that in itself shows you they're not the same. And so yes, to be bullish on one now, I'd only be bullish or bearish on a chart or a particular security if its own chart. So this isn't the reason. I'm not trying to play a game of mean reversion or anything. Again, I think they have just sometimes they are trading together, positively correlated, but it's just coincidence. Again, their lithium is not gold or silver or whatever. And and you look at them today, and again, it's a good example. GDX has been down since I started harping on it lately, and you look at the lithium stocks, and you've got some of them up today, some of them have already reversed. SQM, I did an extensive video recently on them, but and I'm not screaming bullish on them, and just I'm trying to find things that look good on the long side. I'm trying to find do this whole asset allocation thing here, little pieces of the pie, the equities, and within that equity portion, some will be long, some will be short. Commodities. Within commodities, we'll have grains like wheat and corn and soybeans, and then we'll have maybe short other oil, crude oil, or natural gas or whatever at the time. So those are different subsectors. Bonds. Again, I've been analyzing bonds. No current position there. But let me actually get to that, and then I'll finish up. I keep telling you I'm going to stop. But TLT, the 30-year. Look at this. We've come full circle. You can see on this is a 60-minute chart. I like to look for these divergent highs and then sell signals to go short, which we did there. Divergent low, go long, divergent high, short, drop, divergent low, rally, divergent high, drop, another divergent high, drop, divergent low, rally, trend line break. Must have targets here. Yep, we did, because this was an actual trade. Hit our first, second, third target. Divergent low, I highlighted it then at the time, and we've come now full circle. This divergent low has played out for a rally. Negative divergence is not a sell signal. It is a condition, but we're at resistance. You could make a case to short at resistance with a stop above, or on a break. See this little minor trend line on TLT? Right there. Break of that is going to trigger a sell signal, take us down to this first target and the trend line. Break of that trend line, since we have a divergent high, that's certainly possible, could send us down even further. And then the stock market will not like this. It might not care right away, but as we start ticking down, it will. So watch this. Looks like bonds may have that divergent low may have played out. May or may not have. I don't know. All I can tell you is there's your sell signal. No sell signal right now. There is a shot you could take at resistance with a stop above, or wait for a break of the trend line there, as I said, and then you can see first support level, second support level, so forth and so on. All right, guys, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great